If you think about, the time when Oaktree was just a tiny little asset manager once upon a time, you now have $10 billion in the global credit strategy alone. How do you start to put that to work in this environment?
There's a lot to do, and so it's been a fun time. But I think the reality is when you look at fixed income, I always find it funny. It's in the name, fixed income. It's about the income. But yet for years, no one's been talking about the income because, frankly, it wasn't very high. Now we're in a period where getting high single digits, low double digit yields is not very difficult to do, and especially when you have a multi-strategy platform where you have lots of different asset categories to look to, there's plenty to buy.
Well, I think a lot of investors are looking around the world right now and saying, how much risk do you take on?
Yeah.
A lot of questions about whether we're in a soft landing and how much risk is that the soft landing turns into a harder landing. What do you think of risk?
I think there was this massive risk rally at the end of last year. I think everybody got really excited about convexity. That was the big term of the year, which I always say is just a fancy word for upside. And so everyone's looking for things with discount, and so the riskier things found to bid. I tend to be a conservative guy. I'm a bond investor at heart, and so I like to say professional pessimist. But right now, I think when you look at the market's kind of pricing in this amazing scenario. We're going to have a soft or no landing. They have at least 5 rate drops in spite of the fact of a soft or no landing, and it sounds great, but it's got to the point to me where it's like the market is pricing in this amazing scenario, and if it just turns out to be pretty good, there's going to be some repricing of risk. And so for me, I think being cautious is more prudent right now.
What does it mean to be prudent in this environment? Because you think about last year and the default rates we saw, the bankruptcies rising to pretty significant levels, but this year, jury's out on how fast that could turn. Do you think this year is better or worse than last year?
I think this year will be a little bit better, as far as the defaults. When you think about the default rate, one of the things we had in our market, usually you have the recession as the cleansing event, but we had COVID. So we had a cleansing event before the recession. So all the really weak companies defaulted during COVID and kind of cleansed out the market. And if you think about it, if COVID hadn't happened, those companies would have stumbled along for till the next recession and then defaulted. But you had in bonds a 5% default rate, in loans near a 4% default rate. So you pulled forward a lot of that impact, and so I think there's going to be less of a default impact in 2024.
You think about what Oaktree has done on the private side, record-breaking fundraising, and a lot of fund managers now have raised a lot of money. How much competition is there to put assets to work in this environment?
I think, when you think about it quite simply, you have a market, especially on the private side, went from, over the past couple of years, from roughly $300 billion to over $1 trillion. It was really quite amazing. And Howard Marks always reminds me, when you have a market that grows that quickly, eventually you buy what you can, not what you want to, and so you have to be really careful. And so I think that when it comes to competition, to me, it really comes down to the ability to pick credits. I think we've very much found ourselves in a credit picker's market, and I always tell people I'm a credit picker, so I'm always rooting for a credit picker's market, but it feels very clear to me we're in a credit picker's market right now, where if you can do a good job picking credit, there's some very good yields to earn. If you're buying the market like everyone else and you have lots of capital to deploy, you're going to find that you're going to have a few hiccups along the way.
How do you think of, and people think about Oaktree, the KKRs of the world, as private credit giants, but the reality is you do a lot in liquid markets too. How do you think about the opportunities, public versus private?
I think right now there's going to be a lot to do on the public side. Liquidity has become a popular thing again. I think a lot of people put it onto the private credit side because you were getting paid a little extra because you needed that little extra because yields weren't very high. Now that the yields on the public side get higher, that's going to become interesting too. And the thing you got to remember, there's this love affair in the market with private credit because it doesn't mark to market. Everybody loves it. The market's up, the market's down, but my private credit stays flat. What I remind people is if it doesn't mark to market, that means you always have to buy at par. And on the public side, there are periods where you can buy at 80, 90 cents on the dollar. And doing that gives you less downside because you're buying at a discount, and it gives you more upside because if you retrace par before maturity, you're going to earn more than your yield. And so I think there's become really interesting opportunities on both sides of the fence today.
How do you feel about how people perceive returns, public versus private? AQR, for example, did a study the other day that said high yield will get you about 3.4%, private credit 3.6%. It's not that much of a difference.
Right.
But is that meaning taking on more risk in private and public markets? Sorry.
Well, I don't think it necessarily has to mean taking on more risk. I think you'll find depending on on the sectors, there's going to be some more risk on the private side, and there's going to be some more risk on the public side. But I do think that the returns are going to be different. I think that on the private side, it's going to be all income. And so the reality is, when you see, depending on where markets are, you'll see there's a pickup in liquidity going back and forth, whether you're getting paid a liquidity premium. You know, it's funny, I have people say to me from time to time, I don't need a liquidity premium. A small piece of my portfolio, I've got a big portfolio, and I always tease people that it's the wrong question. Whether you need a liquidity premium isn't the question. The question is, are you getting paid to bear the risk of illiquidity? You should get paid for every risk you bear. And I think there are periods where you get paid quite handsomely to go into the private credit markets, and I think there's periods where they converge, and it's better to look at the public markets. And I think being flexible in these types of environments is going to be the key to success.
You know, you mentioned some caution a little earlier, the possibility that things could turn.
Yeah.
What do you avoid in this market?
Well, so right now, when I think about the market, to me, it comes down to this concept of the pivot. I think the market is very, very focused on this Fed pivot. I think over the last few years, that's probably the most common question I got. I would talk to people about fundamentals, about market technicals. Everyone said, that's fine, I just want to know when the Fed's going to pivot. And I would tease people, say, well, the Fed doesn't know when the Fed's going to pivot, so I don't know. But what I did tell people, I said, look, I can't tell you when the Fed's going to pivot or how, but I can tell you why. And this is the part that I think is so important when you think about risk in the market, because I feel like the market's totally lost sight as to why. And I tell people the Fed is not in the business of propping up the stock market. As much as everyone wants that to be true, that's not actually the mandate. The Fed's in the business of propping up the economy. Those aren't always the same thing, which means if you believe we're going to be in a market with over 5 cuts in this year, then there needs to be some crisis. And if you believe we're in a soft or no landing, there's no reason to have 5 cuts. You can't have both. But if you believe, as I do, that in this scenario, barring a crisis, rates likely stick around where they are, maybe a little bit lower, but certainly not 5 cuts lower, that means that companies are going to have to pay this interest for longer.
David, quick question here for you, just in 30 seconds or so here. Most crowded trade that you're most concerned about today?
What I'm most concerned about is everybody piling into duration very quickly, just hoping that rates are going to drop and bail them out.